So in this video we're going to be discussing the 2008 General Ledger for Mountain State Sporting Goods. This is the third in a series, so if you have not reviewed the 2006-2007 videos where we discuss the client's practices and how they do this large summary entry, please go review those first and then come back. So here's the heading of the first page of the 2008 General Ledger, and just like in the prior 2 years, we see this empty journal entry that all it has is a debit amount and a credit amount, and there's no description, there's no date. Not a very good practice. But what we have is one great big debit for all the deposits during the year and one great big credit for all the payments for the year. And then it takes many pages to figure out what the other side of the entry is. But most of those deposits, hopefully, are from customers. And most of those payments are for expenses and assets that have been purchased. That's what we expect, at least. Like in the prior 2 years, it was too difficult for me to look over many pages and try to figure out what was going on. So I put all the debits and credits into the spreadsheet so that I can inspect it all at one time. So we have the journal entry to record all of 2008 activity, which was one journal entry. And then we have 2 adjusting entries that were made after the end of the year. So let's start by looking at the activity for the year. Interestingly, and not different from the prior 2 years, the debit to cash is exactly the credit to sales revenue, to the dollar. Interesting. And then there's a series of expenses that look probably like they're supposed to look. There's a debit to loans to employees that's a question mark. We would want to ask about that. But everything else, at first blush doesn't pop out. But let's look over at the adjusting entries. We see them recording the inventory count. We see them recording this year's depreciation. Those are normal year-end adjusting entries. I don't know why we would reduce the auto expense and increase cost of goods sold. Then a couple of weeks later in February, they made a journal entry to reverse the loan to employees and call it equipment. That would be a very strange entry. And then again, similar to the prior year, we have this reclass out of travel into advertising. That makes no sense to me. And out of outside labor into insurance. Also makes no sense. So we have a number of things we want to ask when we get into the interviews. We want to know again why the auto lease is reclassified to cost of goods sold. We want to understand what this loan to employee was and how it converted into an asset or equipment. We want to know why we reclassify $20,000 out of travel into advertising. And we want to know why $8,000 was reclassified from outside labor to insurance. And again, just like in the prior years, we want to ask about what's not there. What receivables may be existing at the end of 2008, what pawn items may exist that may not be in inventory, and also is there any cash that's been paid that has not been deposited that is related to the pawn shop piece of the business. So the next thing that we will be doing is we will be discussing the actual individual interviews, the order in which we will interview folks, the format that each interview will have.